All right, big news out of Washington, D.C. The big, beautiful tax bill has just passed the House of Representatives last night on a vote of 215 to 214, only a one-vote margin got that thing passed. Now, there are some last-minute amendments to the bill, so I want to break down what's in the bill that the House passed. What were some of these amendments? Because I've been talking about this for a while. Those are important to know. And now what's happening next is this is going to go to the Senate. And then the goal is this will be on the president's desk to sign by the 4th of July. So let's dig into the bill here. I want to quickly hit the things that matter for small business owners. There's some interesting and important tax breaks in there for small business owners. And then we're going to hit individuals. This is where there has been some changes in prior bills and the stuff that was going through Ways and Means and went to the Budget Committee. So I'm going to break down what's in and what's out as to individuals. So let's start with small business owners. The biggest one, the best one, the one I love, QBI, Qualified Business Income. This is a 20% deduction small business owners get on their income. You make 200 grand a year, you're only taxed if you made 160 grand a year. You get a 20% deduction on your income. That's going away this year if no tax bill is passed. That is a provision that expires this year. So in the bill right now, QBI is made permanent, and it is actually at 23% deduction. So now you make 200 grand a year, you get a $46,000 deduction, and this is permanent in the tax code, which is fair. Corporate tax 10 years ago, they made permanent deductions. They made permanent tax reductions for big corporate businesses, 35% max rate down to 21. Now, in this bill, they're doing the same thing for small business on this one. They're saying, let's make this permanent. Let's not let it die. All right, the next thing for small business, bonus depreciation is back, baby. This is where you're able to take a deduction on buying equipment or vehicles. Let's say you spend 50 grand purchasing equipment in your business. Let's say you're a contractor, you buy a bunch of equipment or even a qualifying vehicle, $50,000. Right now, under the tax code, starting next year, you only get to take 20% depreciation on that in what's called bonus depreciation. So if I bought 50 grand, I only get to take a $10,000 deduction. That's nice. I'll be taking $10,000 over the next 5 years until I finally get to expense the thing. But under this new bill, you get to take 100% bonus depreciation deduction. That $50,000 piece of equipment or qualifying vehicle is now a $50,000 deduction in 2025. This year, this is going to affect 2025 tax year. Now, the downside on this bonus depreciation rule is it will expire in 2029. Okay, so this is going to go away in 2029. Unless it's again renewed. But this is a big thing for small business owners who are relying on this deduction and using it to grow and build their business, invest in it, buy equipment, qualifying vehicles, and get an awesome tax deduction in the process. Now, remember on that, you don't have to expend the cash to get that deduction. You can buy equipment with financing or even a qualifying vehicle with debt, and you still get the whole deduction. It's not just the cash that you outlay to acquire that asset. All right, let's go into individuals here. This is huge. There are massive benefits here for individuals, and this is where there was some changes in the original bill, particularly on SALT, which I'll get to here in a moment. But let's start with the main ones here, lower rates. Everyone is going to see lower tax rates under this bill, high income, middle income, low income. There's a 2 to 3% reduction in rate under this bill. Right now, we're at this lower rate scheme where 9 years ago, Congress passed a bill lowering rates for 10 years. It expires this year. Everyone's bracket is going to jump back up. For example, if you're at the 22% bracket, kind of middle income America, you're going to go up to 25%. If you're in the highest tax bracket, you're going to go from 37 to 39. Okay. If you're at 12, you're going to go to 15. Okay. Everyone's going up next year unless a tax bill passes. Under this bill, everyone gets to stay at the lower rate scheme. Now, there was talk of the 39.6% highest bracket coming back and applying to those making $2.5 million or more. That was not in this bill. So lower rates are back. Everyone's going to see a lower rate, and these are going to be made permanent. That is critical in this bill. They're not doing another 10-year cliff where this dies again, and you've got to rely on Congress to pass a new tax bill. So this will be made permanent as part of the bill. Okay, next one, doubling of the standard deduction. This one's incredible. This mostly helps middle income Americans because what happens is the standard deduction is something you take on your return when you don't itemize. A lot of high income individuals itemize, right? They have large charitable deductions or mortgage interest and things like that. But the standard deduction is something you get to take even if you don't have those things. and everyone gets the same amount. Right now, that standard deduction is set to go to $16,600 for married couples in 2026. Under this bill, it'll be double that, and it'll be $34,000. Now, I just want to make sure I understand what this means. Let's say you're a married couple, married filing joint, making 200 grand a year combined income. This alone will save you $3,000 in taxes, this deduction, because you're getting a doubling of the standard deduction. It's twice as valuable. You're also getting a lower rate, by the way, which I'm not even calculating into that, which is going to save you even more. So big benefit there for individuals, doubling of the standard deduction. All right, next big one, child tax credit for any of you that have kids. Right now, the child tax credit is $2,000 per child you get to take. That is set to go to $1,000 next year. It's going to get reduced and cut in half. Under the bill, the child tax credit will go back to $2,000 permanently, but there's an additional kicker in there of another $500. So $2,500 for the child tax credit for tax years 25 through 28. Okay, so that's huge because for any of you with kids, you know it's freaking expensive. And this is a tax credit. This isn't a deduction. This is a tax credit. So keep in mind, if you owe $10,000 in federal tax and you have 2 kids, you get a $5,000 credit against that $10,000. You'll only owe $5 grand to the IRS. This is huge, much more valuable than a deduction. Now, again, it's made permanent at the $2,000 level, but you get an extra $500 for 25 through 28. All right, now the last one here I want to touch on. I'm still going to get to overtime and tips here, but let's talk about SALT. Okay, this is the state and local tax deduction. So this applies for those that itemize. So let's say you're in a state that has a high state income, New Jersey, California, New York, and let's say you make, let's say you pay $30,000 in state and local tax for state income or any local taxes you have to pay. Well, right now, under current tax law, you can only deduct up to $10,000. And this was a new cap that was introduced 9 years ago. As a way to pay for all these other tax cuts they did 9 years ago, they said, let's cap how much state and local tax deduction you get at $10,000. There never used to be a cap. 9 years ago, a cap came about, and this is very contentious, particularly within the Republican Party, caused a lot of infighting. This is why the bill got held up last week. This is why the Budget Committee bombed the bill. This was what got negotiated in the last-minute amendment last night, which they said, let's change what was originally proposed. Now, the original bill, the original big, beautiful tax bill that came about was a $30,000 cap. They said, all right, let's not do $10,000, but let's at least go up to a $30,000 cap and increase that. But you phase out at $400,000 of annual gross adjusted income, AGI. Now what they're doing is they've sweetened it a little bit and bumped it to $40,000 as a cap for a deduction for state and local tax, and it doesn't phase out until $500,000. In other words, more taxpayers are going to get this. This is particularly important to people that live in high state taxes, or excuse me, in states that have a high income tax. If you're in Florida or Texas or other states, doesn't matter as much. You might have property taxes or stuff like that. Typically doesn't add up to these amounts. So, but this is huge. This was a big issue, and what was negotiated at the last minute, again, $40,000 cap on state and local tax deduction, and the phase out starts now at $500K instead of the original bill provisions of $400K. All right, let's get to no tax on tips and overtime. This one was interesting. The Senate passed a similar bill already just on this, but here's what we got on no tax on tips and overtime. So let's start with qualifying. Let's start with tips here first. On your tipped income, okay, an above the line deduction, there's no cap, but it doesn't apply to anyone making more than $160K a year. Okay, so once you hit that income level, this deduction doesn't help you anymore. Now, this is only for the next 4 years. For 25 to 28, this will go away. You're going to have to elect people back into Congress that want to extend this. So, but that is no tax on tips. Now, I want to go over the requirements here, though. In order to qualify, this must be an individual or that's in an occupation, whether they're a W-2 or contractor employee or independent contractor that traditionally receives tips. You can't be in some business or in some profession or job and say, well, this is tipped income. No, that doesn't count. Okay. It has to be in something that traditionally receives tips. And the Department of Treasury and the IRS is going to provide further guidance on what qualifies and what doesn't. But basically, what they're trying to say here is we don't want people engineering their compensation to say, well, now I get tipped income. Okay. The next thing is the tip must be voluntary. Okay. So, like, for example, when you're checking out somewhere, you're, at a restaurant and they force you to pay a tip, that wouldn't count here. Okay. The tip must be voluntary. So you must have the no tip option on the display there. Again, this is allowed for employees and independent contractors. And there's going to be further guidance on the qualifying trades. But let's say you're a barber, or let's say you're in some other profession, a bartender, waiter, whatever those professions or jobs are where you typically receive tips. These are the ones that are going to certainly be benefiting from this. Again, above the line deduction, which basically means this is not taxable income to you. That's another way of saying it. Okay, let's get to overtime. Overtime is similar here, above the line deduction. Okay, this basically says if you make overtime pay of 40 grand, you get to deduct 40 grand off your taxable income. So basically makes this not taxable income. Now, this must be paid in excess of your regular rate. Again, let's say 40 hours a week, typically what overtime is being paid for. Now, this also doesn't apply if you make more than 160K a year. Okay, this is individually based, highly compensated. This is called a highly compensated employee under the tax code. And this is also only for tax years 25 to 28. So big benefit here for anyone that has overtime pay under 160 grand a year, or that gets tipped income. Those two buckets will not be taxed now. And there's going to be guidance on how this is going to be handled. We don't know how this is going to be handled for employees, for example, on their W-2. How are they going to be separating their regular pay versus their tipped income? For any of you independent contractors, we don't know how you're going to identify this or not on your tax return, but there'll be guidance from the IRS on this. There's always some guidance after these bills pass on what the heck this means. All right, so that's where we're standing now. 215 to 214, the House passed this tax bill. A lot of people thought it was crazy when they said they'd get this done by Memorial Day. They did. I think there's a lot of benefits here for individuals, a huge tax savings and tax relief for individuals, some great benefits for small business as well. Now, this is going to the Senate. There's likely going to be changes to this. Let me just say, there's going to be changes to this. There's going to be negotiation. The Senate has very thin margins as well for Republicans. And the vote in the House was party line. Republicans backed it. Democrats voted against it. There's a lot of other spending issues in the bill, by the way. I'm just talking about the tax things that matter on your tax return. There's some spending issues on the bill and some other budget items that I'm not talking about here. I'm just talking about taxes, what's going to come out of your pocket and what matters for you. All right, now please make sure to subscribe to the channel. I'm going to be giving you updates on this along the way, but also want to let you know I've got a lot of content here about saving taxes, protecting your assets, and building wealth. No matter what tax regime we're under or what tax bill passes, there's a lot of tax planning you can do to minimize your tax. And at my law firm, KKOS Lawyers, we do this every day for clients across the country, individuals and small business owners, finding the tax strategies, tax structures, and planning that save taxes for you every year, no matter what's in the tax policy. I'm Matt Sorensen. We'll see you next time.